Good morning, everyone. It is 6 a.m., half an hour before the market opens on June 4th. Today is Tuesday. Let's see how the markets open. So yesterday we were talking about how the markets were looking very choppy. We were expecting it to kind of just go in a sideways range because it's waiting for a catalyst, and we don't have any real catalysts until next week. So most likely we're just going to continue to chop sideways. And there's a few things that we need to adjust our trading for if that's going to be the case. But before we get into that, let's see how we're opening this morning. We can see right here that the pre-market looks like we're down a little bit. So let's take a look at our futures. S&P 500 down about 30 basis points. NASDAQ less, about 20 basis points. And then Dow futures about also 20 basis points. So that's interesting. The S&P is below both the NASDAQ and the Dow. So we'll see if that moves and resolves itself, or if that continues. So having the NASDAQ and Dow aligned being a little bit stronger than the S&P 500, that does imply a little bit, not with a strong conviction, but with a little bit of conviction that we may be headed higher for today. So meaning that this, in the pre-market, we are below where we closed, especially even if we include that last minute bar in the session yesterday, we are still below that level, and we're significantly below that level. Or I should say, we were significantly below that level. I didn't see the rest of this chart. We were significantly below that level. Now we're up here. Now we're on the verge of random and non-random. So what we normally would expect with 70% conviction is that this is going to trade higher up to about that 527 level, or in today's case, for about half an hour after the open, until we get the economic reports that are coming out, which are the factory orders and the JOLTS. Those come out at 7. So most likely we will move higher. And then around 7 o'clock, if we haven't hit this level by then we'll level off, or we may hit this sooner and then level off, wait for those reports, and then react to the reports. So there is a little bit of a directional bias this morning, and it's not what the futures are implying. It's actually in the opposite direction because of the way that these are relating to each other. The S&P below both of these implies that the S&P needs to move up and match with both of them. It could be that the other two come down, but it's a little less likely. So at least this morning, it looks like we might just have a little bit of flutter, a little bit more volatility than usual. If we start seeing VIX come down, so we have a slightly elevated VIX, if we see that come down towards the bottom of this bar right here, then that'll be a signal that we're probably going to head higher. So I'd be watching VIX at the same time as the S&P today if I was day trading, and then I would look at these two together. The bonds will still have an effect on the market, but on an intraday tick by tick, minute by minute basis, it's not going to be as important as the VIX. When we look at the relationship between the bonds and the stocks, it's mostly on a day-to-day basis. We don't really look at it intraday. So what we're seeing here is that the bond market is up, and we see that the at least pre-market, the stock market is down. So those are moving in opposite directions. So that is only temporary. It's the VIX. The VIX will give us a better idea of what this will do during the day. And then this will be either that relationship will continue and say, okay, well, it's a little unusual at this particular market environment for TLT to move up and for stocks to move down, because TLT should give it a big boon. But if it does move down, then we know that either it'll revert or there is another force acting on the market that is overcoming this TLT effect or the bond effect. So for now, what we see is that the looks like the TLT is gapping up, and we're very close to this purple line that I drew. So yesterday we talked about how yesterday was a good entry, but not for a full allocation. We thought we would want to split our allocation into thirds. 1/3 yesterday, right at the top of the channel, 1/3 when we hit this purple line, and then our expectation is that it'll pull back down to the top of the channel, and then that would be the third entry, the last third entry. And that way, if it does, for whatever reason, continue to move higher, break out and move higher, then you don't have full risk on. And then we didn't want to miss the potential opportunity for us to for this to bounce down from the channel rather than from this horizontal line. Right now, it's looking pretty clear that we're looking at the horizontal line rather than the channel, given that we're opening very close to that purple line right there. That level is about 92. I have it at 92.33, but again, these are regions and not super precise, so it could be 92.50-ish is that level. So TLT is still a great trade. I might actually issue a trade alert for my students sometime when we get closer to that purple line right there. When we look at our economic calendar, other than today, so yesterday we had the ISM. That did not come out as strong as we would hoped, so it was actually weaker than the consensus and weaker than the prior. So manufacturing is softening, which is very bad news for the economy. It just means the economy, the outlook for the upcoming economy is not that great. The market was sideways, so we didn't react too much to that. But if we keep getting data like that, then that's not going to be good for the economy at all. So if factory orders support the ISM manufacturing, and then our JOLTS report, which is a jobs report, saying like, oh, well, we're losing jobs, our job openings are decreasing, then that will be further sign of weakening. And then we have next week, we have the PMI and CPI. So there is some, these are probably not as well respected as they should be. So when we look at these, the Econo Day is marking these as green, which is somewhat significant, and they labels red as market moving. That's not really the case. The Fed will look at this. I used to sit next to Neil Kashkari when I was at PIMCO. Neil Kashkari is the head of one of the Feds, Massachusetts, one of the Feds. I don't remember which one he's the head of. He's one of the guys who likes to talk a lot. And when we evaluated what the Fed was doing, so I was on the short-term money markets desk. It was my job to follow the Fed and determine what they would be doing, and determine what they were doing would be how that would impact the rest of the markets. And in fact, we were so big, PIMCO at that time was 1.8 trillion in assets, and all fixed income, all paper, all bonds, not stocks. So the Fed would actually call us sometimes and say, if we did this, would you buy more bonds? If you do that, if we did this, would you buy more bonds? Because that was 2008, that was the middle of the financial crisis. They were trying to get people to buy paper to stimulate the economy. So they would actually call us and say, if we do this, would you do this? So we had a pretty good idea of what the Fed would be doing. And we definitely looked at these reports. So these should be better respected, in my opinion, in the markets. So maybe other guys don't look at it, but I know Kashkari is. So uh, when these come out, we'll get a better idea, and then, but mostly for the rest of the market, they'll be looking for the PMI and CPI that are coming out next week. So probably not. These will have an effect on the market for sure. Probably stronger than these color indicators imply, but the bulk of the move will be next week, PPI, CPI. We've got this week, we've got some CrowdStrike, Dollar Tree, HP, not so much, Campbell Soup, DocuSign. So we've got CrowdStrike and DocuSign in the tech market. And then we've got Dollar Tree, that's and CPB, Staples. So these are going to be very important to what, Five Below. These are going to be important to watch because the tech sector is the leading sector right now. And then we have staples. So when we're looking at the economy and the stability of the economy, the consumer staples will give us a strong clue on that. So we'll be watching those earnings very carefully. And then I think that's all I wanted to look at. But Fed Watch, let's see what the crazy bond guys are doing. Usually they're really on top of things. But lately they've been really, really far off. So 16.5%. So that went up. So over when we looked at it yesterday, it said 14 and something, maybe 14 and a half. And then it got throughout the day, got bid up to 15.5%. And then now at 16.5%. This is moving in the wrong direction, as indicated by this upward movement in the TLT. So that will have to come crashing back down into reality at some point before July 31st. And that's why I'm very high conviction confidence that shorts anywhere between yesterday and this price right here, basically the top of the channel and this horizontal line, those are all good entry points. So remember, we're never going to catch the exact top and we're never going to catch the exact bottom. As long as we get within the region, then we're good. We're never going to be the person the person who got this perfect low price right here at 87.34 will not be the same person who got the perfect high right here at 92.42. It just never happens. I've never seen it in my entire career. So it's not going to be the same person or the same institution. Those are just going to be completely different people. And professionals don't care about that. You just want to get within the region and just get the meat of the move right here. Or depending on your style, you don't even care. So if you're a day trader, you would just want to capture this. You wouldn't care about this. So whether you entered yesterday right at the top of the channel, or you entered today, or you enter when you get it, they're all good levels. They're all good price levels because we are almost 90. I've 99.99% conviction that we are coming down. So right now in the market, so after all that, after everything that we talked about, it does look like we have a slight upward bias, but it's not going to be enough for us, or at least it doesn't appear to be enough for us to get to new highs. It's not today anyways. So it looks like chop is going to continue. We should still maintain a neutral stance overall in our portfolios and then take opportunities. What it is telling me, though, is that we need to be nimble, and either our positions need to be positioned for a longer term that will outlast this sideways choppy movement. So we might be talking 2-3 month scale or longer, or we've got to be very nimble and just take our profits very quickly so that we're catching these little tiny waves. and a whole bunch of trades add up into a significant amount of profits. But you've got to be able to have a high percentage win rate in that case, because if you don't, the reward risk ratio isn't enough to overcome a low win rate. If I'm only winning at 40% and I'm just taking these tiny little nibbles, that's not going to be enough. Even if I end up with positive expectancy, I'm just not going to make that much profit. And I'm churning and trading, and I'm paying commissions and trading fees, and it's just going to eat away at my profit. It's very unlikely that we're going to end up with profit that way. So in this choppy environment, if you're going to take profits quickly and take losses quickly, you need a high win rate. So you need a methodology or proven system that gives you a high win rate, 70+% win rate in these types of environments. Otherwise, you're just going to have to take a longer view. So this was a few weeks. This is another few weeks. And then so probably another few weeks. So that's why I said 2 to 3 months. So 1 month might make it, but it's a little risky. So 2 to 3 month or longer view on your position. So something like a rolling 1% extrinsic value might be okay, because then you only need the market to move 1% in order to break even. And this could, 1%, this is right, 0.66%, down 0.73%, up or down 0.7%, 0%. But a couple of days strung together, like this one, 0.91%, that could give you the 1% to at the very least break even and have a safe trade. And then just keep on rolling that month to month. So that's another way to approach this type of choppy market. In any case, we should be fairly neutral in our portfolios. So if we're going to be neutral, then we want to have longs in very strong stocks, shorts in very weak stocks. Days like today, where there's a market pullback, make it a lot more obvious which stocks are strong. It's very hard when they open up because everything looks strong. But now, today, with the market opening down, then all you have to do is intraday look at the stocks that aren't opening down, that are opening even or only a tiny bit down. Then those are strong relative to the market, and the market does trade up in that first half hour, then you'll see those stronger stocks also trade up. So that's what we're looking for. We're looking for stocks that are opening flat instead of down, or maybe even up instead of down. And in the first half hour, move higher or stay flat. So if the market moves higher, we want those stocks to move higher. If the market goes down, then we want those stocks to stay flat. And then we know we have strong stocks strong relative to the market. That's if you're day trading, but if you are swing trading, it's the same thing. It was just that we would wait until today's close, and then you could look at all the intraday data and say, hey, this stock actually stayed very strong relative to the market. That's a good candidate, or at least that's one of the criteria to make a good candidate for a long in my swing trades. So, and then the opposite would be true. But it'll be harder for us to see that today. The weaker stocks will be harder to see today, but the stronger stocks are made more obvious by this opening down or a small, tiny gap down at the open. Just watch the first half hour. Be careful of the volatility that will come in at 7 o'clock, so after the first half hour. But that first half hour can give us a lot of information or clue us in potential candidates for our longs if we're still looking for long-short pairs in our neutral portfolio. Okay, that's it for this morning. I'll leave you to prepare for the market open, and I will see you in the